Hey, how's it going, everyone? My name is Amos, and welcome back to the Dividend Compounder Show. I want to ask you a question. Can you imagine getting a dividend paycheck every single month from your stock portfolio? Well, that's what I'm trying to do when I roll into retirement. So in this video, I'm going to be building out a dividend portfolio that pays a monthly dividend that's also going to be qualified. And to do this, I had to find a list of dividend companies where their payments are on a staggered schedule. That way it ends up being a monthly dividend payout because as far as I am aware, there are no qualified dividend paying company that does it monthly. When we talk about REITs and BDCs, there's a handful. There's more than a dozen. But for qualified dividend payments, you have to be a little more strategic. And in order to develop my dividend portfolio, I made a roster full of 9 companies where when it's all said and done, their dividend payments end up giving out a dividend every single month of the calendar year. So without further ado, let's go ahead and talk about the first batch of companies where their ex-dividend date and their payout might be off by plus or minus 1 week. So it might say something like January 28th or roll into February 1st, but for all case and purposes, let's just go ahead and assume January, April, July, and October. These are the companies that will pay out a dividend for those following months. We're talking about Cisco, which is one of the biggest tech conglomerate companies in the IT and networking sphere. And then we have General Mills, ticker symbol GIS, that has a giant portfolio of food for humans and our pets. And then, of course, there's AES Corporation. You can think of them as a utility and power providing company for those that have a heavy demand for electricity and power in general. And so with these 3 companies, you'll get dividends for 4 out of the 12 months in a single year. However, when we add the next batch of companies, then you're going to get 8 months of dividends or 2/3 of the year. And these guys pay a dividend in February, May, August, and November. And this roster includes McDonald's, Papa John's, and then of course the logistics transportation company known as Norfolk Southern. And to round it out, to have the other 4 months covered, to make it 12 months of getting a dividend every single month, we have PepsiCo, FMC, and Altria. And they pay a dividend usually in March, June, September, and December. As I'm sure you are aware of by now, PepsiCo, they produce and manufacture food and drinks. Altria is in the business of tobacco. And FMC, they do chemicals for our agricultural industry. So very diverse mix of companies hanging out together for March, June, September, and December dividend payers. Now, with $100,000 invested into these companies, the actual total cost is $102,427. But this is how I would break it down, and the allocations that I would assign to each company in order to balance a decent dividend yield while also prioritizing the dividend growth. So in this hypothetical retirement portfolio, I would allocate about 25% of that capital into Altria because when you look at their dividend profile, it is absolutely wild. An 8% dividend yield, and they grow their dividend at a rate that's slightly above the rate of inflation. So 4% year-over-year growth for their dividend. In other words, Altria is doing the heavy lifting and is carrying the team on their back. So in the context of Altria alone, it's going to be this one right here, ticker symbol MO, with about $25,600 invested into them. The annual dividend payout just from Altria is going to be just over $2,000. And then the lowest payer is going to be Cisco, and it makes sense because I only allocated about 3% of the $100,000 into Cisco. So Cisco's annual dividend payout is roughly $80. So you can see Altria is the one that is really doing the work. And the average dividend yield for this portfolio is sitting at about 4.7%. And the weighted dividend growth rate is going to be 6.2%. That means this number right here should, in theory, in a perfect world, should grow at a rate of 6% year over year. So the annual dividend payout with these 9 companies taken into consideration is more or less $4,800, which means if you break it down monthly, every 30 days or so, you should expect about $400 in qualified dividend payments to you. You can use that to pay for the groceries, your OnlyFans subscription account, your bi-weekly weekly trip to the barbershop, even though you know you're bald. I don't know why you spend your time over there. Or you can even use this $400 to pay for your insurance, your utilities, or whatever leftover bills that you may have. All that to show that even with $100,000 to your name in retirement, it can still help out a lot if you focus on dividends. When I visualize retirement, I absolutely think that dividends are a cheat code that's there to help you out alongside with your Social Security payments, and if you cash out of your 401k or Roth IRA, all of that pulled together should add up to having enough money to live in decency in your later years. When you're 66, 73, or even 80 years old, dividends are there to pay you. It's quite literally the definition of passive income. You don't really have to do anything, just the hard work up front to invest into high quality companies and then letting them do their thing, which in the context of the stock market, if it is indeed a high quality company, it should be compounding. So not only should this portfolio valuation be growing, but the dividend payment that you receive every month or every year should be growing as well, even if you do not contribute any more money into this portfolio. But somehow I feel like if you are watching this video and you are already subscribed to this channel, you probably already get the big picture, and I'm preaching to the choir at this point. So this is the $100,000 portfolio with those 9 companies where if you do the math and the schedule, it pays a dividend every single month. But what about if we go a little bit bigger? Let's say you have a little more money in your pocket saved up, or if your retirement portfolio is going to be a little more juicy, then let's work with $1 million. I basically broke it down in the same allocations with Altria doing most of the heavy lifting. And let's take a look at the outcome now. The actual cost of the portfolio itself is going to be just a hair above $7.99 above $1 million, but essentially it should be $1 million. Everything else pretty much looks the same, except the quantity of shares and, of course, the annual dividend payout. Now, with about, 4,500 shares of Altria in this portfolio, the allocation is going to be 23.18%. Then the annual dividend payout, just from Altria alone, this one right here, this last cell, $18,600. And if we look at Cisco, they also pay $808. But overall, the average dividend yield for a $1 million portfolio that is expected to pay you a dividend every single month, the average dividend yield is going to be 4.6%, which means for the first year, you should expect to receive an annual dividend payout that's qualified, by the way. That means it's going to be taxed at 0%, potentially even 15%, $46,250 a year in dividends. When you break that down month over month or every 30 days or so, then you should be expecting $3,850. For most of us, that's more than enough to cover the mortgage, the insurance that's associated with it, and maybe a car payment or two. So just from your dividend portfolio, it covers most of your living expenses. When you throw in your 401k or your Social Security checks, then you should be, in theory, be fine in retirement. And just for fun, your annual dividend payout for the next year should be around $49,194. So it grows from $46,000 to $49,000. So it should, in theory, keep up with the rate of inflation, or if you want to spend some extra money here or there to eat out, you can do that. That's what a dividend growth portfolio or a dividend income portfolio would look like in retirement. And now let's go ahead and make the assumption that this was your actual portfolio in January of 2015, and for whatever reason you decided to stop investing into the stock market and you just let your portfolio do its thing. The allocation is all going to look the same. So January of 2015 to December of 2024, let's see what actually happened to that monthly dividend paying portfolio that has qualified dividend payments. I have to say qualified because if you start thinking about, Main Street Capital or Realty Income Corporation, those dividends are not going to be qualified, right? In roughly 10 years, you could expect your $10,000 would have grown to $23,348, which breaks down to a year-over-year CAGR, the compound annual growth rate when you reinvest the dividends and take into consideration the share buybacks of about 8.8% a year, which is pretty darn good because when you think about, a high-yield savings account, you're lucky to get 3.5%. So for your dividend dividend monthly paying portfolio to grow at a rate of almost 8.8%, I think that's pretty good. And as a benchmark, if we compare it to the S&P 500, which is obviously going to have a smaller dividend yield at about like 1.5 or 1.4%, well, that 10 grand in the exact same timeline would have grown to $34,000. And when you look at their year-over-year growth, that would have been 13%. But mind you, when you look at their best year for the monthly dividend-paying portfolio, it would have gone up by 31%. Likewise, the S&P 500, which is what we investors refer to as the market, would have also gone up by 31.3%. And if you look at their worst year, the volatility for the monthly dividend paying portfolio would have been slightly better, because during the worst time ever, that portfolio would have dropped by negative 12%. And on the other hand, the S&P 500 would have dropped by negative 18%. Pretty interesting to take a look at. And if you are a visual person, we'll take a look at this. The blue colored line graph is our monthly dividend paying portfolio, and the teal one is the S&P 500. They're pretty much neck and neck. However, keep in mind the dividend yield is a lot higher for our blue line. And in the last year or so, the teal line has just been taking off. Why? Why is that happening, Amos? Well, that's because teal is reflective of Google, Microsoft, Apple, Amazon, Netflix, Nvidia, Broadcom. We don't have any of those in our portfolio. And as a result, the difference was really seen in the last about 400 days or so. Now, what makes this even more interesting is when you look at 2019, both of the portfolios almost had the exact same performance. However, when you take a look at the monthly dividend paying portfolio's worst year, which was 2018, it went down by negative 12%, whereas the S&P 500 only went down by negative 4.5%. However, if we look at the flip side, take a look at 2022. Whereas the S&P 500 went down by negative 18%, that's pretty heavy, and that's because of the skewed exposure and allocation to the tech industry. The monthly dividend-paying portfolio went up by 1.4%. Pretty interesting stuff to take into consideration, especially when you are going into retirement. And that's why when I try to develop this portfolio, I try to put compounders in there that have a lower volatility than the overall S&P 500. Because in your retirement, I don't think you're necessarily going to care about the portfolio's valuation, especially if it's a dividend portfolio. However, to see your, $100,000 cost basis portfolio drop down to like 80 grand, it would probably make your stomach turn. However, for the dividend-paying portfolio, the volatility and the downside would not be as bad as the S&P 500. Pretty interesting stuff. And the last thing that I want to mention is, even if the portfolio's valuation drops from like 100 grand down to like 89 or 88 grand, you're still going to get that dividend payment. These companies that I listed into this portfolio, those 9 companies, they are not dividend cutters. Every single one of them are dividend growers. So despite the drawdown, it's only on paper. It's an unrealized loss. Had you have just waited, then the next year, that portfolio would have rebounded and would have been 100 grand again. Or I guess in the context over here, it would have dropped from like 10 grand down to 9 grand. And then the next year would be 10 grand again. And then it would be 11 grand and so forth. So as long as you don't paper hand and sell just because your asset is dropped into the red temporarily, then you would be okay. And I feel like in retirement, a lot of us just want that peace of mind, knowing that the dividend is going to come in on time, on schedule, on the timeline that you want. Because I don't know about you, but when I'm 74 or 78, I don't want to bother with day trading or trying to figure out short-term trades to maximize my portfolio gains. I don't want to be playing any of that nonsense. I just want to invest into high-quality dividend compounders that do their thing, whether they go up or down, but that pays me a dividend on time when I expect it. Because cutting a dividend is not as frequent and as common as people think. In a handful of my videos, I posted research and study and publication after publication of how during the worst times, like in 2009 or the pandemic, literally only about 8 to 10% of the companies that pay a dividend cut the dividend. The rest of them sustain it, or in all of the odds, they increase their dividend, even during times of turmoil and despair. And that's why I highlight and emphasize the word high quality compounders. When you choose to invest into a company that has like a payout ratio of like 140% and their stock price is declining in the red for the past 10 years, can we conclude that that's a high quality compounder? Most likely not. Correct? So I'm talking about the companies that are growing, that will turn your $10,000 in 10 years to $23,000. And the dividend yield should keep up because when you think about it, the growth rate of it was around 6.4% on a 4.6% dividend yield. So if I was an old fart in retirement, I feel like this portfolio would make me pretty happy and help me to sleep soundly at night. That's just me though. But I'll tell you what if we were to do this again, but keeping things more simple and choosing the easier route? So instead of picking 9 or 12 or even 20 different companies in order to have a scheduled monthly dividend payment, what if we were to just invest into monthly dividend payers? Well, that's what we're going to do now. So the monthly dividend payers that I chose for my hypothetical retirement portfolio: Realty Income Corporation, ticker symbol O; Main Street Capital. This is a BDC, a business development company. You can think of them as a large ETF or a conglomerate that has 100 companies under their arm, but in actuality, they're handing out and financing loans for smaller companies that would prefer to do business with a BDC rather than a traditional bank. I think a really good example is Berkshire Hathaway. When you think of that name, do you also associate that with Brooks running shoes or Dairy Queen or some other companies that are under their brand? So that's what Main Street Capital is in a nutshell. That's the BDC. And then of course there's Agree Realty, ticker symbol ADC. These two companies are almost identical in what they do, their business model: commercial real estate. Now, because both of these companies are REITs and this one is a BDC, their dividend payments to you, even though it's going to be every single month, it's not going to be qualified. As a matter of fact, it's just going to be an ordinary dividend payment, meaning that dividend is going to be taxed at your normal income tax bracket. So unfavorable tax treatment, but it simplifies the equation. And instead of messing around with 10 different companies, you only really need to focus on 3 and keep up with 3, especially in the news or investment research or whatever is happening. 3 companies. However, when it comes to monthly dividend paying companies, their dividend growth rate is not that juicy. So as a result, I decided to slip in SCHD as well, which is a dividend ETF that is a favored among the dividend investing community. And it's based on the Dow Jones 100 dividend paying index. And their growth rate, as you can see on your screen right now, is 11.5%. So they're there, but not to do the heavy lifting, but to make sure that the monthly dividend payment is keeping up with the rate of inflation and that it's growing. So with $150,000 invested into this portfolio, this is what it would potentially look like. The actual total cost is $150,010.07. But are we going to really argue about the $10? Please sit down and just watch the video, please. The average dividend yield is going to be sitting at 5.7%. Who has the highest one? Well, that's going to be Main Street Capital at 6.9%. Who has the lowest one? Well, that's going to be SCHD. However, the cards are also kind of reversed because the highest dividend growth rate is with SCHD, and then with Main Street Capital, it's about the same as Realty Income Corporation at 3.7 or 3.5%. So with this $150,000 portfolio, the annual dividend payout that I should expect is around $8,500. When I break that down month over month, that should be around $713 every 30 days. That's pretty amazing. However, when you take into consideration that SCHD pays their dividend every single quarter or every 3 months, that means certain months you should get a higher payout, and then in the other 2 months you should get a lower payout. If you just factor that in your head and think about that and visualize it, it might help you a little bit. And based on the allocation of the portfolio, this number right here should grow at a rate of 4.4% year over year, which in my humble opinion should keep up with the rate of inflation, especially in in retirement. And I don't know about you, but with $700 coming into my pockets every 30 days or so, that's a pretty sweet deal, especially when it's off of an initial $150,000 cost basis. Pretty nice. But just like they used to do at McDonald's, let's go ahead and order a supersized version of this. So with $500,000 invested, this is what it would potentially look like. Now we would have about $28,000 invested into SCHD in order to get that growth, and that would be about 5.6% of the portfolio. The one doing the heavy lifting, the one that's Altria in our monthly dividend paying that's simplified that portfolio, well, it's going to be Main Street Capital, of which 4,000 shares of Main Street Capital should pay out roughly $16,791 every 12 months. That's quite beautiful and just amazing. Now, between you and me, I think Realty Income Corporation and Agree are pretty much neck and neck, pretty solid REITs. However, because Realty Income pays a slightly higher dividend yield at 5.8%, I decided to allocate more of the portfolio's capital towards them in order to get a more juicy dividend yield, if that makes sense. And as a result, 3,000 shares of it should pay out about $9,500. And with Agree, because we only put 926 shares of it into the portfolio, well, that payout is $2,812. So that's the portfolio composition, but what about the final product? What's the output? Well, the annual dividend payout for $500,000 invested into those four simple investment choices, well, that's $30,000. My goodness gracious. When you break that down every 30 days or so, you should be expecting about $2,500 in dividends. And depending on where you are located or your geographic location, $2,500 US dollars could go a very long way, especially if you decide to retire in Southeast Asia or in South America or in a low cost of living area. I think $2,500 should be more than enough to cover expenses. Maybe not for fun money and stuff that you can spend on your hobby or new clothes or eating out, but for your essentials, I think $2,500 should be pretty good. However, let's go ahead and supersize this portfolio one more time. What if we were to consider and look at $1 million? Well, for $1 million, this is how I decided to break it down in the allocations assigned to each investment choice. For Main Street Capital, I decided to put about 42% of the portfolio's money into them. As a result, that's 7,000 shares. That is just a ridiculous number. 7,000 shares of it will pay out $29,000 in dividends every single year. And as you move down and look at Realty Income Corporation, it's just shy of 6,000 shares. And that spits out about $19,000 in dividends per year. That's crazy. I have some people that comment on the Realty Income videos that I produce, and they usually say stuff like, oh, I have 1,000 shares of it. I have 2,000 shares of it. My wonder is there anyone that has about 6,000 shares of this company? If so, you gotta let me know. That means you have full faith and conviction in this company. Like, I am a shareholder of Realty Income, but to invest $300,000 into them, that is absolutely wild, and that's who I want to be when I grow up. I want to own 6,000 shares of Realty. Anyways, as you move down the list right here, SCHD, 2,005 shares of it spits out $2,005. I think that's pretty funny. And with ADC, Agree Realty, their contribution should be about $8,200 in dividends. And what is the output of all of that? Well, the annual dividend payout is just shy of the median income of a person in the US, $58,600. That is absolutely wild, but it takes $1 million in order to get to this ballpark figure. The monthly dividends spits out $4,800. That is diabolical. That is absurd. This almost seems like fake news, except it's not. When you look at the numbers and the data and the facts and the figures, I think that's pretty good. And just for fun, let's see what this number would look like next year based on a 4.2% growth rate. So hypothetically, if you invested $1 million into those four choices, the first year is $58,000. The next year should be around $61,137. And if we divide that by 12, your monthly dividend payout should be around $5,000. And what you see on your screen right now may or may not be the pile of cash that I was able to accumulate when I worked as a stripper. I'm just kidding. I was never a stripper. But my question to you is, what is your dividend payout strategy? Do you even have one? Because I feel like for most of us, we invest into these companies that we believe in as shareholders, and the dividend that we get is nice and dandy, but we don't really have a structured, methodical timeline of spacing it out so that we can get a dividend every single week or every single month. Do you find that to be true, or are you actually one of those people that have tailor-customed your portfolio so that you get a dividend payout every single month, which I think is pretty cool. Then again, I would argue if you have about 20 or even 40 stocks in your portfolio, you probably get a dividend every single month without having to calculate it anyways. Now, with that said, if you are enjoying the content, why not become my very first Patreon? Because I'm going to tell you this right now, so far I'm at a solid 0 signups. So you could be the hero that changes all of that. Plus, you'll get some cool perks and forever bragging rights. To be the first Patreon, dude, that would be an amazing title. But if you choose not to, then leaving a comment on this video and clicking like actually helps out a lot more than you think. If you choose to do nothing, then I'll just go ahead and assume that you're the kind of person to shower first and then poop afterwards, you big weirdo. Anyways, I love you guys, stay safe, and I'll talk to you next time. Peace.